Welcome back to the channel. It's me, Adam. I hope you're doing well. Right now, the S&P 500 and the NASDAQ 100 are in full-on correction mode, well off their all-time highs for the first time this year, pretty much. And we have no idea how long or how deep this correction is going to be. Is this the beginning of something bigger? Are we going to be trading sideways for the next 3, 6, 9, or 12 months? Or are we going to rebound right from these levels back to all-time highs? It's anyone's guess. You can't time the market. But what we do know is that the big technology stocks, Facebook, Apple, Amazon, Microsoft, Google, NVDA, PayPal, all these big tech stocks have a huge impact on both indices because they make up so much of both of them. With the S&P 500, I think the FAANG stocks make up like 20 or 25% or so, and for the NASDAQ, it's upwards of 40%. So whichever direction those big technology stocks are going, most likely the SPY or the triple Qs are following in that direction. And in this video, I want to talk about my favorite option strategy, LEAPS, and combine that with the FAANG stocks. And again, I have no idea how long or how deep this correction is going to be, if we're at the bottom or if we're nowhere nearby. But if you know how to buy the right LEAPS option for the long term, it could bear very fruitful for you. And we're going to be taking a look at all the big tech stocks and different strike prices for different deltas, which pretty much controls how many underlying shares you have of those stocks. And then we're going to go from there. Before we do, if you're new to the channel, welcome aboard and hit that subscribe button. Here at Unlimited Options Investing, we talk everything from stocks, crypto, options of course, and we're investing for the long term. As always, smash that like button and let's get started. All right, we're first going to take a look with Apple stock. But the first thing I want to get out of the way is that for the expiration for every one of our examples, we're going to take a look at the January 2023 calls. And a lot of people will be asking, why not just use the January 2024 calls and give yourself more time? So the reason for that is if I'm buying the January 2024 calls, I'm going to be paying, well, there's two main reasons. The first thing is I'm going to be paying more because there's more time value, because you're paying for an extra year in that contract. And the way I'm looking at it is that, because in general, what I always do when I buy LEAPS is either I'm going to close out my position, take my profit, and then that's the end of it. Or if I'm planning on holding that stock or that option for a longer amount of time, what I'll do is before time decay starts to really ramp up and decay from the value of my option, I'm going to roll it over for the January 2024, but I'm probably going to do that sometime like a year from now, pretty much. So maybe September 2022 or something. And the reason for that is because essentially instead of paying for the time value now, I'm paying for the time value 1 year at a time. So instead of paying for it all at once up front, I can keep more cash in my pocket and then pay it for next time. And since I'm going to be rolling it over anyway, like I'm going to be buying the time anyway for it, but why not pay it next year instead of paying it right now? The second main reason why I wouldn't buy 2024 call options right now either is because there's less liquidity because it's more far out in the future. And less liquidity means there's a larger spread between the bid and the ask and a less chance that I'm getting a more fair price versus a LEAPS option that's 1 year away is going to be much more liquid than one that's 2 years away. Anyway, moving forward. So right now, as of today is October 13th. I believe today is a Wednesday. Right now, Apple is trading for $140, give or take. And what we'll do for each example is we'll look at one at the money. So right now, 140 would be that strike price. We'll look at one in the money, deep in the money, and one a little bit out of the money as well, and look at how the profit potential and the risk potential is different for all three scenarios. All right, so for Apple, if you were to choose at the money, a year and a few months out, and because it's Apple, it's more liquid than the average stock as it's the biggest stock in the market. So for about $1,800, you'd be getting a delta of 55. So as if you have 55 shares, because for every dollar that Apple goes up, your option price will be going up about 55 cents. So it's as if you're taking control of about 55 shares. Taking out our trusty calculator, if we take the delta and we multiply it by the current price of Apple right now, it would, if we were to buy the shares outright, it would cost us $7,823, but instead we'd be paying about $1,800. Well, and you essentially double up your money once Apple goes up about, let's say, to 165, give or take. And from where we are right now, 165 is about a 18% gain, but you'll be gaining 100% in your options call. And that is the power of leverage, but also know that if Apple goes back down to, like, let's say 130, you'd be down $490, and you'd be down about 30% on your call option. So now let's take a look at something that's a lot more deeper in the money. Let's say 110, let's say. So it would give us about 78 shares. And right off the bat, what we see is the deeper we go in the money, the more expensive we're paying. But of course, we're getting as if we have more shares under our belt as well. So the delta is 78.73. Let's round it up to about 79. again, multiplying it by 140 times 23, about $11,000 worth of Apple for about $36.50. And if you were to go out of the money, let's say to 160, that would be a lot cheaper. It would be almost $1,000 for the call option, and your delta would be just under 40. And looking at the profit loss graph, so this purple line signifies today's date, and the second one signifies the date upon expiration. And the difference between these two lines is the time value. But let's say we zoom out, or we go to, let's say, February 1st. We see the purple line retract closer to the green line, and that's the time value decreasing from your call option as time passes by. But what you'll notice is the closer we get to the expiration, again, that time value ramps up. So that's why I like to roll up my options, let's say, at least 3 months prior to expiration before that time value really starts to kick in. So regardless of whether you pick in the money, at the money, or out of the money, and it were to move short term, it doesn't really matter because all of them are going to go up significantly. But the deeper in the money your option is, the more money you're going to be making at least. Because you're going to be controlling so many more shares, however, the out of the money is so much cheaper and more affordable. It's extremely important to know how to roll your options or you lose a lot of unnecessary money. Alright, and taking a look at Microsoft, so changing it to 2023, and we're at the money at $295. So you'd be paying a price of about, let's say, $3,500 for a delta of about 54. So multiplying 54 by about 295, which is the stock price right now, about $16,000 worth of Microsoft for $3,500. And similar to Apple, it's actually pretty liquid compared to the average stock because, again, it's Microsoft. Changing the strike price a little bit more in the money, let's go to about, let's give it an 80 delta. So that would change us to a strike price of about, let's say, 220. So it would be much more expensive to be buying this call option. It would be about $8,500. But at the same time, your delta is about 80 shares of Microsoft. So again, the amount of leverage that you get from options, a lot of people go way too hard, way too fast because they don't realize that they're leveraged enough. Something else to take a note of, the deeper in the money that I got, the less difference there is between time value from right now to January 2023. So in order to get a double in this call option, you would need the price of Microsoft to go up to, let's say, about 390, which is about a 30% gain from where we are right now. But again, a 30% gain in the stock price would give you a 100% gain in your LEAPS option. And going out of the money with a strike price of 330 costs about $2,000 for a delta of about 40 shares in Microsoft. All right, next up we have Facebook. So let's change that again to 2023. So the strike price of at the money at 325 costs roughly about $4,900 for a delta of about 60 shares. Going deeper in the money, let's change it to, again, an 80 delta. I gotta go really back for that one. So about 250, wow. So going that deep in the money, the option will cost you $9,300 for a delta of about 80. And going out of the money, let's choose at 380 because that was the all-time high that we hit about a month ago. Would cost about $2,700 for a delta of about 40. Next up, let's take a look at Amazon. The first thing we know about Amazon is that it trades per share above $3,000. So naturally, the cost of these options are extraordinarily high. So taking a look at the money with a delta of 57, taking out our calculator, 57 times about the price right now, which is $32.75. So if you want to control $186,000 worth of Amazon, you can buy an at-the-money LEAPS call option, and you would only have to be paying a quarter of how much the shares would cost you at $42,700. And going deeper in the money, let's choose a delta of, again, let's say 80, give or take. So let's say a $2,500 strike price to control 82 shares of Amazon, which would be about $268,000, would cost you a cool $90,000 for that call option. And if you wanted to go out the money, let's say to about $4,000 LEAPS option, would cost you a much more affordable $17,500, giving you a delta of 32, which would equate to shares equaling about $104,000 or $105,000. And lastly, taking a look at Google, and similar to Amazon, it also trades for over a few $1,000s per share. So taking a look at the money, again, 2023, for a delta of 57 shares, this bid ask is actually a lot higher than what we noticed in both Apple and Microsoft. But that could also be dealing with the nature of a stock that has a share price in the multi-$1,000 range. 10 times the share price of Microsoft or 20 times the share price of Apple. So you'd be looking at 57 shares of Google for about $35,000. And going deeper in the money, let's choose a $2,000 strike price. That's actually a little bit higher of a delta at about 85. But just to give you guys an idea, that would cost roughly about $85,000. And if you wanted to go out of the money, let's choose $3,200, for example. Your price to buy that option would be roughly $17,000. So pretty intriguing stuff, guys. Again, there's so many different options than choosing just LEAPS options. You can just buy the shares. You could buy them through ETFs, options through ETFs. There's so many different possibilities to create wealth in the stock market. There's not one way to do it. We can all reach the same destination using different methods. And that's the end of my video. Thank you very much for watching. Let me know in the comments below if you invest in LEAPS options, whether it be with the FAANG stocks or not the FAANG stocks, and what strike prices you use and expiry and what your strategy is. Let me know in the comments. As always, smash that like button, hit that subscribe button, and I will see you in the next video.